Dividend investing is a great way to generate steady returns on your investments. It allows you to enjoy the benefits of compounding returns without the need for frequent trading. By following some simple tips, you can ensure that you are getting the most out of your investments and increasing your yield over time. Hi, my name is Lulu, and in this video, we will explore some of the best tips for dividend investing so that you can maximize your gains. Diversify your holdings of good stocks. Diversifying your holdings of good stocks is an essential strategy for investors to maximize their yield and get the most out of their investments. By diversifying, investors are able to spread their risk across a wide range of investments, helping to reduce losses in one area while maximizing gains in another. With a diversified portfolio, investors can benefit from market movements without taking on excessive risks. Furthermore, by diversifying across sectors, industries, and asset classes, investors can protect themselves against any sudden drops or shifts in the market. By investing in good stocks that offer long-term potential with higher yields than average investments, you can increase your return on investment and maximize your wealth over time. Diversification benefits: lower risk. Diversification helps to reduce risk because it minimizes the amount of money tied up in one stock. Investing in many different stocks provides a stable supply of income while also providing the opportunity to achieve higher returns on investment. By spreading your investments over many different asset classes, your portfolio is less likely to be affected by a single market or company's actions. This allows investors to put more trust and confidence in their investments, which can lead to better results in both the short and long term. Choose financial stability over growth. Choosing financial stability over growth is essential for investors looking to maximize their returns on investments. This approach helps ensure that investments are made in highly secure and reliable companies that will continue to produce consistent yields even through difficult times. By avoiding risky investments that could potentially lead to big losses, investors can focus on building a portfolio of diversified assets that are stable and can generate steady returns while minimizing risk. One of the greatest benefits of investing in stable, reliable companies is that gains are realized even in difficult economic times. These companies will continue to pay out dividends month after month so that investors can rely on steady incomes rather than fluctuating values. Investing in highly secure, reliable companies will provide investors the peace of mind necessary to stay calm and keep investing. Investors can feel confident knowing that their investments are already diversified, so they have no need to constantly monitor the market for new opportunities. Find companies with modest payout ratios. Investing your money in the stock market is a great way to increase your wealth, but it's important to be mindful of the payout ratio when choosing companies to invest in. The payout ratio is the percentage of earnings a company has paid out as dividends divided by its total earnings. Companies with more modest payout ratios tend to be better investments since they are more likely to reinvest their profits and grow, thus providing more potential for higher returns for investors. Finding companies with modest payout ratios is essential if you want to maximize your yield on investments and get the most out of your money. To give you some examples, Google has a payout ratio of 53% and Disney has a payout ratio of 33%. McDonald's has a much higher percentage, with 60% going to dividends. These numbers show that it is important to research the specific companies you invest in if you want to see them as potentially profitable investments. The dividend discount model. Another way to assess how good a company is at investing its earnings is through the dividend discount model. Find companies with a long history of raising their dividends. Increasing your yields is a key part of any long-term investment strategy, and finding companies with a long history of raising their dividends is essential to achieving this goal. Companies that have consistently increased their dividends for many years are more likely to continue raising them in the future, which means higher returns for investors. As a dividend growth investor, you can invest in companies that have consistently raised their dividends for an extended period of time. Checking for a history of dividend increases is one way to screen out the companies that won't continue paying you over the long term. Another strategy is to look for high-quality companies with consistent earnings and revenue growth. Companies with these characteristics and a history of dividend increases are more likely to raise their dividends over time as well. Reinvest the dividends. Reinvesting dividends is essential to increase your yields and grow your money over time. When you reinvest the dividends from investments such as stocks, bonds, and mutual funds, they compound over time, allowing you to earn more each year than if you had not reinvested. By reinvesting your dividends, you can maximize the return on investment of your portfolio and gain financial security in the long term. Advertisement, for example, if you invested $100 in a company that paid you $10 each quarter in dividends and reinvested them, and then the company earned another $15 per share in the fourth quarter of 2016, you would receive a total of $180 for your original investment. That's an increase of 18% from your original investment. Reinvesting dividends is essential to increase your yields and grow your money over time. When you reinvest the dividends from investments such as stocks, bonds, and mutual funds, they compound over time, allowing you to earn more each year than if you had not reinvested. By reinvesting your dividends, you can maximize the return on investment of your portfolio and gain financial security in the long term. Diversify your weighting to include 5 to 7 industries. Investing in multiple industries is the key to generating higher yields. Diversifying your weighting portfolio to include 5 to 7 different industries is essential in order to maximize returns and minimize risk. By spreading out your investments across a variety of different industries, you can take advantage of sector-specific opportunities and mitigate potential losses due to market fluctuations. Diversifying your weighting ensures that you have a mix of stable and profitable investments, as well as ones with more growth potential, so that you can maximize profits over time while minimizing overall risk. For example, when the economy is booming, many companies are expanding into new markets and hiring more employees. These types of changes in the economy create investment opportunities in certain industries. This can be a great time to invest in these sectors because the market is highly likely to continue moving higher and make significant gains over time. The key to successfully investing in multiple industries is understanding the differences between each sector. For example, if you're an investor looking to buy stocks in the technology industry, it is important to understand that there are several different types of companies within this field, and they all have different investment approaches. Among these different company types are pure-play internet companies like Google and Facebook, and traditional tech giants like Microsoft and Apple. In order to correctly invest in the appropriate industry, it's important for investors to understand which type of company they are investing in so that their portfolio reflects that type of investment. Thank you very much for watching.